Good morning, traders. Today is the 1st of February. My name is Neville Hornsey, market analyst for trading, and today we're taking a look at the US dollar. Okay, before we get into the charts, we're going to look at the Forex Heat Map on YouTrading.com. We can see here Chinese yuan is red, but we're going to discount that because it's a bank holiday for them as they celebrate their New Year's. Looking up here, US dollar is the weakest currency across the board. And then the pound appears to be fighting with the Swiss franc and the yen for the strongest. We do have a red block building the bottom left-hand corner and a green block building top right-hand corner. So for me, this is a risk-off day today. So we're expecting to see equities come back down. And we're also expecting to see commodities tumble too. Going into the economic calendar before the charts, Australian RBA cash rate stayed as is, so 0.1% is their cash rate still, and they are going to stop their asset purchases in a few weeks' time. So they are looking to tighten monetary policy, but they're also going to wait and see if they can get inflation to stick above 2% to 3% before they do any other sort of measures. We're looking down here, German unemployment change, seasonally adjusted for January, came in a lot worse than expected, minus 48,000. It was expected at minus 6,000. Even the previous reading for December got downgraded to 29K, so another minus 6K in that reading. So German unemployment is not good. German manufacturing PMI is expansionary. It's 59.8, but it did come in slightly under expectations. EU market manufacturing final PMI, it's the final reading, so most of the data has kind of been priced into the price action already, but coming in just under the previous reading and expectations, so not good for that. Whereas the UK manufacturing PMI final for January actually beat expectations in the previous reading, and so that's good for the pound. EU unemployment rate, pretty much the same as it was before, just slightly under expectations by 0.1%. And then later on today, we've got Canadian GDP and ISM manufacturing from the US before the US API weekly crude stocks here. So this is the data point I think is going to be the most market moving, though it does happen pretty much at the same time as all the other ISM manufacturing elements here. And if we go to a chart, you can see that in the blue shaded boxes are the last four recessions. So we're starting with the COVID one here. Then we've got the 2009, 2007 GFC. Before that, the dot-com bubble. It's quite hard to have a recession when manufacturing PMI is above 50. So when manufacturing is expansionary, so above 50, it sort of shows that the economy is expanding. Obviously, it can decelerate into the 50 and then below, and then that leads into a recession. And quite possibly, we could be on that downturn now. But for sake of argument, it's basically come off a very steep rise from a very steep decline. So to come back down into these sort of more sort of averages, like into the mean, so maybe around 55, I think that's kind of expected, really. You can't keep expanding at this sort of rate. So there has to be some sort of normalization. So the lowest of the expectations today comes in at 56. If it comes in below 56, then some alarm bells will be sounded. But until we get below 50, I think we're okay in terms of the US economy. Obviously, if it accelerates a lot quicker towards the 50, then that I think is a problem. Looking at the active trader platform, on the left-hand side, we've got the sentiment indicator for the US dollar index, March 2022 contract. You see that 53% of traders are looking to go short, whereas 47% are looking to go long. So that's pretty much balanced. When I say balanced, I mean that we get this sort of price action where the buyers and the sellers, are equivalent. They match each other's orders, and it just goes sideways. We are seeing a decline after this big rally up here. So we had a big drop, then a base, and then a rally. That obviously looked like a fake out from this balance area. And we just had the opposite happen on the other side of this line. So $97, we had a big impulsive move up. So a big buying opportunity here, then a balance area, and then a drop. So, where's it going to go next? Well, it could stay in this sort of zone between 97 and 95.50. It could just go sideways for a little while, depending on what happens this week with the economic data. I'm pretty sure it's not going to stay in this zone for very long. We have been marking higher because of expectations of interest rate hikes by the Fed, and the US 10-year yield has been rising too. So what happened before? We had this balance area here. So the buyers and the sellers matched each other. This line here around the 94.50 became resistance. And then as price faked out of this balance area, it sort of found these sort of highs, if you like, as support, where it had been resistance before. When the price action popped out on the 27th of January last week, obviously there was a chance that these highs here could act as support, having been resistance before. That didn't happen. We came back into the range. We're in the middle of the range now. So where's the DXY going to go next? It could come all the way down to the 200 period moving average here. The stochastic is overbought, signaling that maybe the buyers have run out of steam. So there could be a target to the downside. If that was to happen, we'd take out this swing low here from 17th of January, and then that would change the market structure to be more bearish. That'd obviously be not good for the DXY, and the 200 would be the sort of last line of defense for the bulls. What I am expecting is, when I said like balance and imbalance before, obviously when we've got traders matching each other's orders, prices go sideways. When there's just an overwhelming number of buyers, we get these big green candles here. So what I think is happening is this red candle and today's candle is just backfilling these impulsive moves here. So my next sort of line, if you like, in the sand for seeing if the bulls are still in control is the high of this day here, 25th of January. So if today's price action tests this wick high here and carries on down, then the next zone is here, where there's obviously an impulsive move before the buyers and the sellers sort of match each other's orders. I don't actually expect the dollar to come down much further, really. I think it is testing in the middle of this range, this high here, and I'd expect to see a rise higher. So I'm looking to go long the dollar still. But obviously, if I don't see a rejection of this level, this 96.255, then I'm going to wait. I'm not going to sort of just buy. I want to actually see a rejection of this level. If it doesn't happen, then I want to see this zone here around the 95.50 to 95.80 reject before switch into more of a bearish stance. Whilst we're making higher swing highs and higher swing lows, potentially we're still in the bull trend. So I don't want to sort of try and pick the top. I want to actually see market structure change to the downside. And like I said, whilst manufacturing is rising or expansionary, I'm not expecting the US dollar to sort of weaken significantly until we see like a contraction. Right, I hope that makes sense. Obviously, keep an eye out on the economic calendar for what the data is, and then sort of keep an eye on this level here, this wick high here, or this balance area here for some sort of support. All right, I hope that makes sense, and I'll speak to you again tomorrow.